Today, I'd like to share a candid personal insight with you. For a full decade, I believed I was being clever with my finances. Yet unknowingly, I was committing 5 hidden habits that ultimately drained a tremendous amount of wealth. This morning, I calculated the figures, and some of these errors will ultimately deprive me of $750,000 or even more throughout my working life. In my view, every single one remains entirely preventable. I'm opening up about them here so you can benefit from my missteps and steer clear. The initial trap I fell into completely escaped my notice. Between roughly ages 21 and 26, I embraced this flawed belief that unless I could strike it rich quickly, there was little reason to make any effort. I was raised in Silicon Valley, California, and during my first year of university, Facebook launched as an entirely novel platform. Back then, we were still relying on MySpace and AOL Instant Messenger. The technology industry was emerging, yet it hadn't become so pervasive that companies like Facebook or Nvidia dominated headlines in the Wall Street Journal or on CNBC every single day. Jumping ahead to 2010-2012, I returned home after attending college in Los Angeles. For context, Facebook went public in 2012, marking one of the largest initial public offerings ever. I personally knew several acquaintances employed at promising startups, and a few grew extraordinarily wealthy. They secured stellar exits, or their firms were purchased early on, rewarding them as initial team members. During those formative early 20s years, I concluded there was truly no value in patiently accumulating assets. My strategy narrowed to joining a trending enterprise, securing an early position, and awaiting an IPO or lucrative acquisition. I genuinely viewed that as virtually the sole path to prosperity, either that or launching my own venture. What I entirely overlooked from ages 21 to around 26 was consistently contributing to broad market index funds. I perceived stock market participation as somewhat hazardous. I failed to grasp how powerful an 8% average annual return truly is, and it struck me as rather dull. Consequently, I chased accelerated gains. Today, I observe a similar pattern among Gen Z. Across TikTok and Instagram Reels, there's a widespread notion that younger folks have abandoned gradual, conventional wealth accumulation. Instead, many pursue speculative gambles, chasing 100x cryptocurrency surges, engaging in reckless sports wagering, or even prediction platforms where people bet on events like potential government shutdowns or random daily high temperatures in cities. Here's the stark reality of how this outlook harmed my finances. From 21 to 26, I avoided the market entirely. My earnings then averaged about $40,000 annually. Not substantial, yet I resided with family and managed to save considerably. Suppose I had simply directed $500 monthly, roughly $6,000 yearly, into investments during those 5 years. That totals around $31,000 contributed. When I computed it this morning, the outcome was eye-opening. If that $31,000 had remained untouched in a straightforward S&P 500 index fund, by age 65 it could compound to between $750,000 and over $1 million, depending on the precise return rate assumed. By opting for inaction in my early 20s, the true price of hesitation proved enormous. Even believing you're awaiting an ideal moment is still a choice, and that choice yields 0% growth. Zero compounded across decades remains zero. I firmly believe disciplined budgeting and steady progress can still lead to substantial riches. If you're part of Gen Z, please share in the comments how this resonates with your perspective. The second unconscious pattern that eroded my wealth persisted perhaps until 3 years ago. A pervasive scarcity outlook toward finances. My father always maintained roughly $35,000 in his checking account. When I inquired why, he'd reply, "It's secure to hold extra liquidity. You never know when you'll need it." He prioritized accumulation so intensely that he avoided expenditures capable of enhancing our quality of life. He opted for frozen dinners at home, despite affording restaurants, endured discomfort by skipping heating in winter, and sacrificed personal comfort and memorable experiences merely to amass more reserves. He attributed this to his upbringing amid hardship and conflict in China, where poverty shaped a deep-seated hoarding instinct once resources arrived. What often goes unspoken online is how profoundly parental attitudes and habits regarding money transfer to children. I absorbed my dad's cautionary approach without awareness. This mindset reinforced my reluctance to invest until 26, mirroring his preference for ample cash reserves over market exposure. Only after deeper personal finance study did I recognize the far greater cost lay in prolonged inaction. Examining reliable historical data, I saw the market has delivered approximately 8 to 10% annualized returns since 1926, with dividends reinvested. Trusting those statistics required effort, but around my 26th birthday, I committed to market participation and shed the get-rich-quick fixation. That shift felt daunting initially, yet the growth has far surpassed what idle cash could ever achieve. One of my absolute favorite visuals illustrates the outcome of investing $2,000 annually over the past 2 decades across 4 distinct approaches. 3 involved equities, with varying timing, poor, excellent, or lump sum, while the 4th held everything in cash. Remarkably, even the least favorable equity scenario vastly outperformed the cash holder. The lesson is clear: invest consistently, maintain a diversified allocation, and build just a 3-6-month emergency reserve first. Trust the long-term evidence rather than fear short-term volatility. The third hidden saboteur was lacking any clear direction or objective for my savings. As mentioned, investing began at 26, but initially only a fraction of reserves went to work. I clung irrationally to excess liquidity, partly from scarcity thinking, yet also because those funds served no defined role. At 26, with low living costs at home, I held $55,000, $60,000 saved. My calculated 6-month safety net was about $12,000, leaving over $40,000 without purpose. It wasn't designated for a home purchase, business launch, or anything specific, just parked idly in a checking account earning near zero. Idle capital without assignment fails to generate returns and steadily loses purchasing power. My solution involved purposeful allocation. I consulted personal finance communities, like relevant subreddits, and established 6 months' expenses in emergency reserves, $12,000, a modest buffer in checking, $5,000 for convenience and peace of mind, with the balance dedicated to growth investments. Even then, my deployment lacked structure, no systematic dollar-cost averaging or disciplined lump sums, just sporadic transfers based on mood. Reflecting now, that casual approach was suboptimal. If this describes your situation, savings without intent, start here. Honestly assess your true monthly spending to size your emergency fund accurately. Then, assign every dollar a specific mission. Just in case isn't valid. Acceptable purposes include near-term goals like a house down payment in 2 to 3 years. Unassigned amounts belong invested, or at minimum in high-yield savings. Treat your finances like a business. Each dollar is an employee requiring a productive role to contribute meaningfully. This mindset shift yields lasting advantages. The 4th wealth destroyer stemmed from my social circle in my early 20s. My peers showed zero interest in investing, entrepreneurship, or income growth. Discussions centered on gaming weekdays and socializing weekends. No sharing of knowledge about markets or business. This created an invisible wealth ceiling. Without anyone normalizing disciplined investing, it barely crossed my mind as viable. Despite Silicon Valley roots, young adults then rarely discussed retirement or portfolios. Everything transformed when I entered financial advising. Daily exposure to colleagues debating ETFs, market movements, rebalancing strategies, and client allocations heightened awareness enormously. If you're engaging with this content, you're already cultivating an enriching environment focused on prosperity. Commend yourself for that step. Examine your own surroundings. If wealth-building conversations are absent, seek communities, online forums, local meetups, where such topics thrive. I don't fault my old friends. They're wonderful and friendships endure, but our collective atmosphere hindered progress. Surround yourself intentionally with influences that inspire growth. Finally, for a decade, I misapplied risk aversion. I dreaded principal loss in equities, especially fresh off the 2008 crisis when markets plunged 35 to 38% rapidly. Yet I ignored two far deadlier threats: inflation erosion and opportunity cost. Inflation diminishes purchasing power by roughly 2.5 to 3% yearly. Over 24 years, that halves real value. Opportunity cost means uninvested funds forgo potential earnings elsewhere. Holding excessive cash to avoid risk actually selects alternative hazards, inflation decay, plus foregone compounding. If cash piles sit awaiting perfect conditions or because equities seem too volatile, recognize you're embracing different and often costlier risks. If any of these patterns echo your experience, drop a comment below. Share specific topics you'd like explored. I'll read them all. Expect more personal stories and financial insights ahead. Subscribe for updates and check the linked video on optimal bank account balances for deeper guidance. Thanks for joining. Catch you next time. Peace.